Alright everyone, Cowboy Trades here. Welcome back to the channel for a quick update. In today's episode, I want to provide a quick update on Bitcoin and the cryptocurrency markets before looking at the most recent rally that we've seen in Bitcoin and the equity markets and talking about can this time be different based on previous data that we've got from the banking sector, the bond market, the options market, and the interest rates. But before we talk about that, like I said, let's dive into a quick update on the cryptocurrency market. So 2 days ago, we provided the Bitcoin bull market checklist and we updated everything that's going on in the lower time frames and the higher time frames. This was a 22-minute video and I did discuss how for the next week or so, I don't think we're going to be seeing any major significant moves. We have seen a little bit of a move down from about 31,000 down to 30,000, but this is really what I think is going to be playing out. Like I said in the past video, I think the next week's going to be a little bit boring. I think we're going to continue to break down until about 29,600 before we see a short-term bounce back up to the 30,000, which could potentially flip as resistance. I think this could take about a week to play out before breaking down to some more significant price targets like 27,700 and then down to the 200-week moving average at 26,700. There's really not too much to update on that front. So like I said, if you do want my full thoughts on Bitcoin and what is happening in the markets right now, be sure to check out my previous video. For the next few days also, I do proceed to believe that we are going to continue breaking down a tiny bit more, lollygag a tiny bit, chop a tiny bit before that next major breakdown, like I said, to 27,000, then to around about 26,000. All in all, I think this week is going to be relatively boring for the markets, unfortunately. So we won't take up any more of your time than necessary. My thoughts haven't really changed on Bitcoin. And in terms of the total altcoin market, you can really see some moves are starting to happen quite quickly. We discussed this in the previous video, how we said Bitcoin's probably going to be boring for this week, but because the altcoin market cap closed right underneath the resistance of the 200-week moving average, because it closed right underneath the bull market support bands and the EMA ribbons, we are expecting a harsh rejection this week for the altcoin market. Now, while the altcoin market is only down about 1.7% today, you can see the majority of altcoins that I cover, like Solana, ADA, KDA, Gala Games, Elon, Jasmy, Cake, a lot of them are down about 5% today. So once again, like we said in the previous video, I expect further continuation for these. I expect us to come all the way back down to the bottom of this trend line, which if we come down in the next week or so, could be about another 8% drop for the altcoin market. And for a lot of the volatile altcoins that I cover, like Solana, etc., these could drop down maybe about 20%, 15 to 20% in the coming week or so. Like I said, if you want my full thoughts on Bitcoin and altcoins, then be sure to check out the previous video, Bitcoin bull market checklist, and we'll talk about all of this in a little bit more detail, and this should prep you for what is happening in this week. But in general, this chart here is my current prediction for what should be developing for Bitcoin in the immediate short term. Now, before we dive into previous data from the banking sector, bond market, options market, and interest rates, and looking at Bitcoin and the S&P 500 and discussing, could this rally be different from previous bear market rallies? We have just a quick message from this video's sponsor, that is Trezor. If you do hold any cryptocurrencies and you are starting to DCA into your favorite projects right now, getting ready for that next bull run cycle, make sure you actually hold your own cryptocurrencies. Make sure that you do have a hardware wallet. If you don't have a hardware wallet right now, I do personally recommend Trezor. I am, of course, an affiliate of Trezor. They are the only company that I've partnered with in my entire YouTube journey after turning down many different offers. So if you want to secure your cryptocurrency with the best hardware wallet company in the market, then be sure to check out Trezor products. I'll leave my affiliate link in the description down below, and you'll also see it pop up on the top right of the screen. So let's dive right into today's video and talk about, is this bear market rally any different than previous ones we've seen? Starting off with the banking sector. On this chart, we're looking at banks tightening standards. Now, when this ratio goes to the upside, this basically tells us that banks are increasing their tightening standards for who they are willing to lend credit to. When this line is decreasing to the downside, this lets us know that they are decreasing their tightening standards and they are more likely to loan to really anyone who wants any line of credit. Now, basically what we've seen in previous recessions, previous major bear markets throughout the economy, of course, this is a chart which trades all the way back to the 1990s, and Bitcoin doesn't have that much trading history. So we're going to look at this in terms of the S&P 500. But if you are looking at most recent data points, which have also happened in Bitcoin, you will see that when tightening standards went up, Bitcoin did also see short-term turmoil back in these regions. What I really want to highlight is in the past 30 years, we've had 4 major spikes in the bank's tightening standards. This is back in the 2000 financial crisis, back in the 2008 financial crisis, in mid-2020 following March of 2020, and what we're currently witnessing right now. Banks are increasing their tightening standards once again. There are many reasons for this. The delinquency rate of credit is currently going up, meaning that a lot of people are defaulting on their credit card debt. The interest rates are also going up, which means that credit is less readily available and credit is more expensive. Thus, this is why we're seeing the banks increasing their tightening standards. Now, very plain and simply, you can see every single time in the past 30 years, we've seen the tightening standards go up. In the year 2000, this resulted in a recession almost immediately after the major increase. Now, you can say, this was because the 2000 tech stock bubble, but what really happened diving further into the tech stock bubble? Lots of delinquencies on credit. Lots of people were unable to pay back their credit, which made banks tighten their standards for who they were going to lend credit to. Of course, if you imagine, if you're in a bear market, if you're in a recession, the delinquency rate starts going up for whatever reason, lots of people aren't paying back their credit card loans, then if you're a bank, you're going to be a little bit more reserved as to who you are going to be lending credit to. So in the 2000 financial crisis, you saw the equity markets break down as a result of delinquency rates going up and the banks tightening standards rates going up. In 2008, you saw a massive increase, which also did play a major role in this massive recession that we saw. And of course, in the year of 2000, we saw banks tightening standards go up. The equity markets did have a slight crash. These reset very quickly before running back up to the upside. And since these started running back up to the upside following July of 2021, this is where you saw the equity markets start to break back down to the downside. Now, they have been seeing a rally since October of 2022, but they are rallying against the banks tightening standards, which are continuing to break to the upside. So at least in this regard, I wouldn't be bullish while the tightening standards are increasing. Credit is very unavailable in the markets to most people, and I do believe a lot of people have already FOMO'd in with most of the funds that they can afford, and I don't believe much more liquidity could flow into the global equity markets or the cryptocurrency markets, and I pretty much think that we are topping out at this moment in time. Now, in terms of the bond market, there's two different charts that I want to talk about. That is the US yield curve and the iShares TIP ETF. We could have broken this down further. I could have pointed out the fact that the 2-year government bonds are rising, the 10-year government bonds are rising, and also yield curves throughout different economies. For example, the German yield curve, a lot of European countries as well have different yield curves, which are currently seeing these deep inversions, not just in the US, which we will discuss in one second. First of all, let's look at the iShares TIP ETF. The iShares TIP ETF is currently in this major bear flag to the downside, and the fact that most US government bonds are taking a huge run to the upside is a major indicator that the iShares TIP ETF, the Treasury inflationary protected securities, could be taking their next leg back down to the downside. This chart is kind of basically the inverse of the US government bonds. Now, we've highlighted this before on the channel. If we look at the S&P 500 and if we look at Bitcoin, you can see if I highlight times where the iShares TIP ETF has topped out, it often tops out a lot before either Bitcoin or the equity markets does. I'm just going to show you 3 examples of this. During the bull run top, you can see the iShares TIP ETF topped out and the equity markets followed about a week later. Bitcoin followed on the same week. If we look at the next peak for the iShares TIP ETF, the Bitcoin markets topped out 2 weeks later, the S&P 500 topped out 3 weeks later. If we look at the top in the iShares TIP ETF over here, Bitcoin topped out 2 weeks later and the equity markets topped out 2 weeks later from this. And if we clear up this chart, what I want to highlight is that the iShares TIP ETF broke down into new bear market lows on the week commencing the 29th of August 2022. And if we overlay the S&P 500, you can see this is where the bond market made new lows, and it took approximately about 41 days for the equity markets to come down and find their next local bottom. Now, if we're looking at Bitcoin in comparison to this, Bitcoin followed about 1 to 3 days later after the iShares TIP ETF broke down. So at least looking at the bond market in the eyes of the iShares TIP ETF, a lot of these markets are diverging against the bond market. They're diverging against banks tightening standards. So this would be a sign to definitely be worried about in the immediate short term. Also, the yield curve, something that we haven't covered in quite some time, because at least looking at the monthly time frame, not too much has happened in the past few months, but what has happened in the past week or two is the yield curve has broken back down to the downside. Now, the yield curve is a great way at getting an idea of what the bond market currently thinks is going to be playing out next for the equity markets. Of course, this chart goes all the way back until 1888. So in general, we're just going to be looking at the S&P 500 for this, but you can see there was a deep inversion of the yield curve down to 0.5% in 1989, and there was a recession which did follow just after this. There was a deep inversion of the yield curve right here on the year 2000 before it did take a run to the upside, and as it started to recover, this is where we saw the 2000 financial crisis. In 2006, we saw a deep inversion of the yield curve, and after 2006, when the yield curve started to run to the upside, a year or so later, this is where you saw the global financial crisis in 2008. So the yield curve often breaks down, it heavily inverts, and then when the bond market believes that the equity markets are about to experience the most amount of pain, it begins to re-invert back up to the upside, and it begins to go back up. So what are we currently seeing right now for the yield curve? The yield curve is at an all-time low. In its entire history, it's all the way down here at negative 1.021%, and it hasn't even started to revert back to the upside. So when the bond market believes the equity markets are about to experience the most amount of pain, and this finally starts to rush back up to the upside, in my opinion, we could see a absolutely monumental crisis, particularly playing out in the equity markets, which could definitely crush valuations for about a year or so. Now, moving on to the options market. Previously, we've looked at different charts over on Bloomberg, such as the options sentiment, which let you know when things like the put to call ratio is increasing to the upside. So keep things nice and simple, when there's more puts than calls, this is typically bearish. Now, if you want to learn more about options, if you don't know what options are, if you don't know what the options market is, if you don't know what put to calls are, if you don't know what put to call ratio is, I have an educational series covering the options market, and I will leave a link to that down below, and I'll also pop that up on the top right of the screen right now. The options market is a little bit more complex than the equity markets and the cryptocurrency market, so this will take too much time to describe in this video. If you want to learn more about it, that is down below for you. But all you really need to know from a technical perspective is that when there's more puts to calls, the options market is bearish. And the put to call skew right now for the options market is extremely high, and the equity markets are currently rallying against this. Now, if we come over to TradingView, we can find a nice little indicator, which is the put to call oscillator. When this inverts to the downside, this is an indicator that there's lots of interest in puts. When it reverts to the upside, this shows there's lots of interest in calls. Once again, when there's more puts than calls, that's typically bearish. When there's more calls to puts, that is typically bullish. So if we're looking at the put to call oscillator, what I want to highlight specifically for Bitcoin right now, because this is something that we can run on Bitcoin instead of the equity markets, you can see a lot of these macro tops that play out over in Bitcoin, which I will highlight here. Bear in mind, this one down here, we did have about a 5 or 6% correction. So not all of them are indicators that you're going to have a huge correction. For example, we had one over here. The previous one we looked at was a 6% correction. This one over here was a 9% correction. You can clearly see a lot of these do have major corrections associated with them. But at least in general, there are some significant corrections, whether it's 5%, 10%, or 50%, we do have some corrections that do take place after we see this inversion in the put to call oscillator. And right now, the put to call oscillator was extremely inverted, and it's starting to move back up to the upside, indicating that the bottom for the put to call oscillator may already be in, indicating there's a lot of strength in the put market in terms of options, and this could be signaling the next local top for both Bitcoin and of course the equity market. Now, of course, if you want, you can pause the video and you can also look at the S&P 500 down here in red, and you can look at what happens when the put to call oscillator tops out, and you can compare this to local tops in the equity markets. But I'll leave that for you to do. Pause the video and check that out if you want to check that out. Nonetheless, it's pretty much acting exactly the same as Bitcoin. And finally, very briefly, in terms of the interest rates, can this time be different? Can we experience a bull run when the interest rates are up at 5.25%? Well, the interest rate chart says no. If we look right now, we're at 5.25%. If we look at where we were just before the 2008 financial crisis, we were at 5.25%. If we look at where we were in the year 2000, we were up at 6.5%. And all of these major increases in the US interest rates have caused some major increases in banks' tightening standards. The availability of credit diminishes as the tightening standards of banks increase. And subsequently, because of this, when the interest rates are extremely high, credit is hard to come by, money is hard to come by, and this is typically when you see large sell-offs in equity markets and quite recently cryptocurrency markets, because bear in mind, they really haven't been around for too long. So there we go, that's all I've got for today, my friends. In my opinion, I don't think this time is going to be any different. Based on the charts that we've looked at, I don't believe this bear market rally is going to be any different than any previous bear market rallies that we've seen. I don't believe a bull run can happen with all of this economic data that we are currently seeing. And in terms of Bitcoin and the altcoin market, like I said at the start of the video, we provided a short-term update, but I don't think anything has categorically changed from the previous video that we presented. In the immediate short term, I see it's moving down to 29.6. And for the next week, I kind of just see a little bit of chop to the side, not really breaking up, not really breaking down, a little bit of a boring week before that next major melt back down to the downside. So for today, my friends, that's all I've got. If you did enjoy the content, make sure to let me know down below by leaving a like and a comment, share the videos with your friends. If you want to further support the channel, feel free to click the join button on YouTube and become a member today. Follow me over on Twitter at 618_cowboy. It's been your boy Cowboy Trades. I'm out. Peace.